Thank you, Mr. Chairman, and thank you all for being here. During the financial crisis, Congress bailed out the big banks with hundreds of billions of dollars in taxpayer money, and that's a lot of money. But the biggest money for the biggest banks was never voted on by Congress. Instead, between 2007 and 2009, the Fed provided over $13 trillion in emergency lending to just a handful of large financial institutions. That's nearly 20 times the amount authorized in the TARP bailout. Now, let's be clear. Those Fed loans were a bailout, too. Nearly all the money went to too-big-to-fail institutions. For example, in one emergency lending program, the Fed put out $9 trillion, and over two-thirds of the money went to just three institutions: Citigroup, Morgan Stanley, and Merrill Lynch. Those loans were made available at rock-bottom interest rates, in many cases under 1%, and the loans could be continuously rolled over, so they were effectively available for an average of about 2 years. Now, in Section 1101 of Dodd-Frank, Congress said no more backdoor bailouts. It recognized that the Fed should still serve as the lender of last resort, but that there should be strict limitations on its emergency lending authority so that big financial institutions could not count on the Fed to bail them out if they made a bunch of wild bets and then lost. Now, recently, the Fed released a proposed rule implementing Section 1101. Dr. Meltzer, do you think that the Fed's proposed rule on emergency lending prevents backdoor bailouts as Congress intended?
No. I congratulate you, Senator Warren, for keeping this issue alive. I mean, it is a disgrace that we got so much money thrown at such low interest rates at so few banks. And the Dodd-Frank Act, at its heart, may talk about getting rid of too big to fail. But at the heart of the Dodd-Frank Act, the Secretary of the Treasury is authorized to do exactly what secretaries of the Treasury have been doing for years. The way to get out of that is to get the Fed out of the too-big-to-fail business, pass the Brown-Vitter bill, which says the bank is responsible for its errors, make it have capital. Now, why did we move away from that? You see, we started with the idea that the government's responsibility was a legitimate responsibility to protect the payment system. We've shifted that to where it protects the banks. We want to go back to protecting the payment system, and we want to get them out of the too-big-to-fail business.
So thank you, Dr. Meltzer. And what I want to do for just a second is stay focused on Rule 1101. You've got the larger picture, but I want to stay on this part because there's a rule pending right now from the Federal Reserve Bank. Last August, I joined with Republicans and Democrats to send a letter to the Fed urging it to strengthen its emergency lending rule. Three others on that letter are on this committee: Ranking Member Brown, Senator Vitter over there, and Senator Cotton. And the letter included some specific ideas for strengthening the rule, trying to prevent this form of backdoor bailout. Won't stop them all. We've got a lot of things we need to work on, but this one. So, Dr. Meltzer, I just want to run through some of the ideas that were in our joint letter and ask you if you could just briefly give your thoughts on them. So, one suggestion: establish in advance that any emergency lending will be offered at a penalty rate, not a rate well below market rates.
Yes, because that leaves, for example, the example of banks taking the money that was pushed on them, insisted upon, and using it to buy up other banks.
All right. Second one, establish in advance that emergency lending would not be available to any institution at or near insolvency.
Yes.
Good. Third, establish in advance that an emergency lending program is for a system-wide problem and used by a number of institutions, large and small, not just to bail out one or two giant institutions.
Yes. That's a way of protecting the payment system, which is essential for the maintenance of the economy. But it's not important. If we have the right set of rules, we don't have to worry about bank failures any more than we have to worry about corporate failures.
Thank you. And let me just try a fourth one here. I'm a little over time, but if I can do a fourth one. Establish in advance that any lending facilities would be made available only for a short, defined period of time so that banks could not excessively roll over the loans.
Good.
Good. Thank you. Thank you very much, Dr. Meltzer. This is a critically important aspect of Dodd-Frank that the Fed has just glossed over. If big financial institutions know that they can rely on the Fed to save them if they start to falter, then they have every incentive to take on more risk and to threaten the entire system. These rules aren't yet final, so the Fed still has an opportunity to place real limitations on its emergency lending. But if the Fed fails to do that, I believe Congress should act. Thank you, Mr.